One of the most common points of confusion for new investors is the difference between return of capital and return on capital. The problem is, if you don't understand what's actually being returned and when, it's easy to misread your investment performance. Today, John and I are going to be breaking down the difference on how each one impacts your total returns and what to watch for in your next real estate deal. Now, if you are looking for a real estate investment and you're not sure what to invest in, there's a lot of uncertainty out there. There's tariffs talk right now. Go to fulloutinvesting.com. You'll see our 10-step investing process, and you'll also see a sample deal of what it would look like if you were to come in and partner with us on our next investment. Go to fulloutinvesting.com, and you'll see all of that in a very simplified way. John, it's great to be here with you.
Nice to be here, Mark. We've talked about this on other podcasts, but that idea that sometimes, there's terms that are used in a certain industry that aren't always as clear to people that are maybe newer to it. And so return on capital seems pretty straightforward, but we wanted to spend some time just giving our investors and any listeners a clear understanding of the differences and why they're so important for real estate investing. So excited to be here today.
Yeah, no, it's good. And, for tax purposes, that's probably one of the biggest differences between the two. And I think that there's different operators that operate differently as well. And so one of the things that we realized, John, getting into this industry is that when you speak to 10 different attorneys or lawyers, you get 10 different answers in regards to the best structure, and then 10 different operators, there's 10 different ways of going about it and thinking process. And so we spent a lot of time speaking with many of them, and then we formed our own perspective and our approach of what Faris Capital Partners is all about, and moving forward on how we can best protect our investors. We want to minimize tax. We don't want to dabble in any of the gray areas. We don't want to do anything, as many accountants call it aggressive, or that's a little aggressive. It's like, okay, no, we want to stay away from anything like that. But we also don't want to overpay for tax. And I think that's where, at the end of the day, if you speak with one accountant, you'll get one answer. If you speak with another, you'll get different perspective on how things are, and creative ways to fall within the tax code. And I think where the biggest disconnect is, John, with many accountants, is that some are just more detailed oriented, where they actually read the tax code, where it's like the big thick tax code, whereas many of them just won't go there. They'll have more of the general practice where they're doing the average Joe, where it doesn't make a difference. But in our investments, like, we're talking about tens of millions of dollars here. And so for us, it took a long time to be able to find the right accountant to be able to structure it, not only for our American investors, but for Canadians, and to be maximum tax efficiency for both sides. John, quick story on our accountant is, it took me 2 months to get him to say yes to work with us.
Really?
2 months.
Yeah.
Yeah. So I got an introduction through one of my buddies, that extremely well-off businessman. And he's like, yeah, he's the best. He's the best. And so it's this tax accounting firm. They do a lot of the billionaire work. And our accountant is one of their top guys. And he just wouldn't get back to me. And I, it's like, me, John, I'm a dog on a bone. So like, if I want something, and I think it's the best thing for the investors. It's like, one of two things are going to happen. I'm either going to get a yes, or I'm going to just keep continuing to ask for the order until you give me a reason why it's not the best option. Now, sometimes you follow up with people and realize, hey, listen, it's just not going to be responsive, and it's not going to be the right fit. And that's fine. We change our decisions on an ongoing basis based on new data that comes in. But in this case, since he's brought us on, he's been excellent and has done a really good job. So getting the right accounting advice and counsel is extremely important. And so how we structure our investments is through wise counsel. And we're going to be talking a little bit more about that today.
It's a sign of a good account when they have a full book, right? If you call the guy up and he says, yeah, send over your information, I'll do your taxes later today, that's maybe a red flag, especially to your point when you're doing these complex deals. So, I had a very similar experience with my current accountant. I had to had to fight a little bit to get in there, just because he had a full book. But thankfully, my financial planner had a relationship, and she helped make it happen there. But it kind of goes back to it's the patriotic duty to pay the taxes you owe, but not a dollar more, right? And so, understanding the tax code, understanding what is totally legitimate ways to reduce your tax liability, everybody should be thinking about. And not only the accountant, but the firm he works for has a lot of experience in this style of investing on both sides of the border. So our investor partners are well looked after. So let's talk a little bit about return of capital, Mark. Can you walk everybody through what return of capital is?
Yeah. So let's just take, for example, so in our investments, we have investors coming in at $1 million. We have investors coming in at 500,000. Our minimum is 100,000. And so let's just take 100,000 and make it easy. On average, our distributions and our deals, our cash and cash returns are in around that like 5 to 7% range, in that range. So let's just say, we'll say 5% to make it really simple for math. So if you invest $100,000, the distributions we had just mentioned on our past podcast is that our distributions start within 3 to 6 months, and then we do a catch up 3 to 6 months after closing. Then there's a catch up from closing, and then it's monthly after that. So at the end of the year, you invest 100,000, you get $5,000 total in return of capital. And so there's two ways you can go about this. You can do return, you can report it for tax purposes. There's two ways to think about it. There's tax reporting, and then what your overall returns are at the end of the day. And so for tax purposes, we structure our deals as return of capital. So that means that if you invest 100,000, you get 500,000, or that would be a really good return, 500,000. You get $5,000 back as return of capital. Now, why this is better than return on capital is that if it was return on capital, that $5,000 would count as income tax. And if you have to pay tax on that at the end of the year, you have to report it. But for us, we structure it as return of capital, which means that your $100,000 actually went down to $95,000 for tax purposes. That's why we structure it that way, for tax purposes. And so we sat down with our accountant and said, what's the best way to structure these deals? He said, for returns, we structure as return of capital. Now, for projected overall returns, our projected returns are based on return on capital, which means that if you invest 100,000, our investments on average return 20% a year. So at the end of the 5 years, it's doubling the investment to 200,000. And so what happens is that if the 5,000 is returned year one, another 5,000 year 2, year 3, year 4, 5, just to make it simple, because our generally in year 3, 4, and 5, our distributions go up much higher than 5%. But for the sake of this exercise, we're going to say 5,000 a year, which is 5% a year. That means that your 100,000, you will return $25,000 of that. And there is no tax along the way because it was return of capital. And so what happens is when we sell the asset, there is a recapture part there. So we kick the can down the road, there's a recapture, and then there's a capital gain there on the rest. So from the 75 to 100, there's recapture, and then there's the capital gain on the remaining amount from 100 to 200, which is the best kind of tax you want to pay. So in effect, you kick the can down the road in regards to how much tax you pay until you sell the asset, which is very, very tax efficient. In regards to the overall returns are based on the 100,000. And so even though you're getting return of capital, you're not getting diminishing returns on how we structure it and how we project out on these deals. So you're essentially getting the best of both worlds. And John, there are many investors, they get into the deal and they're like, oh, even though we've maybe said it before, it just didn't trigger.
Right.
And so this is where for us it's really important for investors to know that these deals are extremely tax efficient. That is one part. We have another whole part where you can depreciate these buildings for further tax advantages, especially for American investors that have access to bonus depreciation, cost segregation, 1031 exchange. We'll do a whole other podcast on that, John.
Yeah.
But the return of capital with the upside, with the overall returns on return on capital is extremely efficient and a major advantage in these investments and how we structure it.
That's right. And, for an investor, thinking about it, is there anything they need to be mindful of? Their tax slip, is this going to answer all those questions? What do they need to be mindful of, if they're investing in one of our deals today?
Yeah, like they can, the beauty of it, and I've jumped on the phone with investors, accountants before, and they, ask the questions, and, it's very simple answer in regards to, okay, how does it work? Well, at the end of the year, for American investors, they get a K-1 tax slip. Very simple. On the Canadian side, it's a T5013 tax slip. It's very simple. They're investing the Canadians are investing in a Canadian limited partnership. Our American investors are investing in a Delaware limited partnership. So both of them are getting maximum tax advantages, and the overall returns net before all the tax advantages, because on the American side, I'll just say that American investors have a much better strategic and overall, we'll say, better tax upside than the Canadian investors. And that's just, we've maximized it on both sides of the border. It's just bottom line is, as an American investor, you get more. You get to keep more, you get more advantages from a tax consequence standpoint. And, who knows with new government if that'll change, likely not as much as the American side, but that I think it's just a matter of you get a good accountant, but regardless of your accountant, you get those tax slips. And if you ask them the question of, okay, is how Faris Capital structured efficient? They will tell you it's extremely efficient, and it's simple enough for every accountant to understand how we'll say simple our tax structures are in all of our investments.
To summarize, right, return of capital is your money you originally invested basically coming back to you. So often taxed at a lower rate. You want to get with your CPA on that, but that's basically not necessarily representing profit. It's your money coming back to you. And then return on capital is the earnings and profits generated as a result of you investing that money. So just to put it simply, that's what we're talking about here today. So to learn more about this topic and just our full 10-step process, our full-out investing process, go to fulloutinvesting.com. You'll find that great video we've mentioned along with a sample deal, and you can book in a time to talk with us about the uncertainty, really anything that's on your mind, real estate investing, anything that comes up. We're here to serve, and we'd love to connect. So fulloutinvesting.com.
Thanks for listening, guys. If you enjoyed the show, please share and subscribe to the channel and share with other high net worth investors that you think will benefit from it. We love and believe in you guys. Keep dreaming and investing big.